Good afternoon, everybody, and howdy from Texas. This is Fred Schmidt presenting bear markets and applicable investments. Some of my key desires was to understand historic bear bull market cycles as it relates to what is the norm, what's not the norm. Understanding our history allows us to interpret what the future may or may not hold and when to get excited if, for instance, we read a sensational article from the Wall Street Journal. Wanted to get more familiar with some of the negative beta investments. So, what would you invest in during some of these market corrections, aside from just put your money under the mattress? And based off of those negative beta investments, what would be some investment strategies aside from a simple buy and hold diversification? So, without further ado, just taking a quick peek at the S&P 500, some of the historic bear markets. There have been 9 major corrections over the past 50 or 60 or so years. There's an average decrease per bear cycle of about 35% in asset price. So that would basically, if you had $100,000, it would just evaporate 35% of it, and you'd be left holding $65,000. And that money would take 1.2 years to disappear. So these bear cycles don't happen overnight. Granted, the quickest one on record is the Black Monday. As you can see here, that happened on August 25th, 1987, also known as the flash crash. And some interesting things here. So I'm going to go into deeper detail on the last 3 major ones, just because they represent about 30 years of investment history. Just to kind of outline some of what the columns represent. The first 3 are start, stop, and the percent decline during that particular bear cycle. The duration is how long it took for that decline to occur in years. A recovery date represents what day did the S&P 500 break above its previous high that was established on the start of the bear cycle. So, for instance, on March 24th, 2000, the S&P hit around 1,500. It didn't touch that value again until May 29th, 2007. So it took it quite some time for it just to get back to its previous high set at the beginning of the dot-com bubble. Now, this precession span, what that essentially means is where was the floor established, and I'll go into a little more detail about what that number means. But essentially I'm going to use the dot-com bubble again, 3.2 years before the bubble, the bear market started for the dot-com bubble, is where it hit its floor. So I'll kind of go in the next chart and I'll show what that means. So right in the middle there, this is kind of an outline of the S&P over the past 30 years with bear, bull, and some major corrections. I can't say like a huge correction between 10 and 20%, but what you can see here is if hopefully my cursor works, but at the end of the dot-com bubble, that S&P, that floor was established 3.2 years to the left. So it just kind of shows you if I got into the S&P 500 3.3 years before the bubble, then I actually wouldn't have seen as much of my real money disappear. I would have only lost the time to invest, and that's actually a pretty big deal, but it's a different story. Overall, just wanted to show some of the 10 major corrections that are between 10 and 20%. Those are the yellow bars there. The reason this matters is because the market just doesn't go straight up and then straight down, straight up and then straight down. You can see here there's kind of waves to it all, and so those 10 corrections with the additional 3, as you see here, represent 13 dips for the S&P. Moving on. So now that we've kind of seen some of the previous charts, how do I make money in a bear market besides just holding my cash and praying? Gold treasuries are the safe storage of value, is really where they're the biggest commodity there. Their assets, they're highly liquid. They have a lot of long-term stability. Both have been acting as that storage of value capacity for quite some time. I looked into other assets, that should have had a lower beta or a negative beta, but these just ended up being the best. Now, with history, there is a way to short the S&P through an ETF as well. So if anybody's interested, that's SH. So got to keep moving here. I'm running short on time because I talk a lot. But as you can see, some of the beta, some of the gains over that period, for the most part, the positive gains indicate that these investments did gain value here. And so if I could forecast the future, based off of 2 charts ago, kind of showing the major corrections, we have about a 50% chance of having a correction every 1.84 years. It's been 1.79 since our last correction of greater than 10%. So if we're just using probabilities for the past 30 years, we have a 50% chance of having a correction of about 10% or more coming up. So flip a coin, lose 20% of your value. Kind of important when you're making an investment decision on whether or not that another 1-2% gain in the market's really worth it. And then if you were to time properly, and this is having foresight, and this is where forecasting comes in, this is predicting the future, so this is highly speculative. If you were to get into the S&P 2 year or get into gold 2 years before the recession, as you can see here on Black Monday, you would have gained 46% by the end of that Black Monday bear market, versus in that same trade for the S&P, you would only gain 35. So this is kind of an interesting one. Where the trend really kind of shines right here is in the Great Recession, where you can see if you got in 2 years early, which is this reddish bar here, you would have doubled your money, versus if you would have stayed in gotten into the S&P 2 years before the recession, you would have lost 43%. So risk-adjusted return is just kind of an important thing to be caveating. So now, just once again, you can always diversify through a buy and hold, an efficient frontier, which is the bottom right. But I kind of took some creative leeway and said, hey, what would our returns look like if I actually just got into a bear market portfolio, which would consist of negative beta assets like treasuries or gold. Let's say this gray bar here is 6 months before the actual recession started. Then if I would have done that for the previous 3 periods of major corrections, I'd be sitting on roughly $4 million, versus if I would have just sat and buy and held the S&P, I'd be sitting on about 1.5 when starting at $100,000. So, gets into timing, and that's where people make a lot of money. That's why, I'm working on a financial engineering degree, all jokes aside. But if you're just really good and you want to wait, as you can see here, I thought this was a very interesting finding. 6 months after a recession starts, if you then get into a bear portfolio, you would see 213% return over the S&P of just a buy and hold strategy. So even if you don't want to do any of this forecasting baloney and you just want to wait, as long as you act quickly once the evidence is there, and that's where you're going to have to determine that, you could walk away still making a fairly sizable return for yourself or your investors, depending on it. So once again, I think this is kind of important information for understanding risk return on when to enter and exit a bull and or bear market. This is important for me because I have a 401k plan, so knowing when and where to kind of seek safety prior to euphoria setting in is of critical value. So, as Warren Buffett should say, his number 1 job is protecting his capital. The number 2 job is then making profit off of it. So, I look forward to reading any questions on the Blackboard, and appreciate class and all your insights. I'm looking forward to watching everybody else speak. So, Voice in the Sky, signing off. Thank you.